Welcome back to another episode of Policy and Profits. I'm BJ Antoni. I like to play an economist on TV, but more importantly, I am joined by the one, the only trader extraordinaire, head of Ascalon 6 Capital, Anthony Esposito. Anthony, how you doing today?
EJ, I am well. I am well. Thank you very much. I'm very sorry that I missed you on my one-day trip to DC yesterday, but I'll catch you next time. How's everything going down there? I know you've been busy. I've seen you out on quite a few shows recently. You're out on X on Fire. Saw you on Kudlow yesterday. How's everything going?
Busy, as you said. We we got a lot to talk about. The market certainly keeping us on our toes. A lot of developments in in financial circles, not just in equities, but financial markets more broadly.
Yep, absolutely. You had been out just to start, and this is something that I kid around about, but it's true. The reverse repo function facility
Mm-hmm.
is something that really does throw me for a loop sometimes, and understanding how it fits in the Fed's plan and policy, and what the effects of it are. And you were out on X. You had a really good post just to get right at it on where we are as far as the reverse repo facility. And you've been at this for a while, but we're basically getting down to zero.
Right.
So the fun begins. Reverse repos are drifting. Reverse repos meaning Fed is selling assets, treasuries off of the balance sheet, right? And they're taking in cash, so taking in liquidity from the banks. But they're basically at a point now where that's going to end. Is that right? And what's the effect of that?
Yeah, exactly. So this is a short-term tool, and it's meant to soak up liquidity, as you said, as compared to regular repos, which are designed to inject liquidity. Again, also on a short-term basis, because as you said, this is a way to get stuff on or off the balance sheet, get liquidity in or out of the marketplace. But the reason they're called repos is that's short for repurchase, meaning one party makes a purchase and then the counterparty makes that purchase, reverses the trade in like 24 hours. So this is just an overnight, essentially, loan, whether it's a loan to the Fed or a loan to, again, a counterparty. What we've seen with reverse repos, though, was this frantic effort by the Fed for several years to try to soak up all of the excess liquidity that they had created. Now we're at a point where they don't need to do that anymore because that excess liquidity doesn't exist, at least not given where they want interest rates to be. So as this goes down to zero, all of a sudden that means there is no more excess liquidity. Liquidity is at just the right level, again, for what the Fed wants it to be. But that's only if you continue to hold everything else equal, will this stay where it is. What I'm getting at here, Anthony, is the same conditions that have been bringing reverse repos down still exist. And so that means the Fed no longer needs to soak up liquidity. Pretty soon they're going to need to start injecting liquidity. And a lot of people have thought, okay, like this is going to be catastrophic. A bomb goes off or something when reverse repos hits zero. No, not at all. It just means we're going to switch from the Fed trying to soak up liquidity to the Fed having to inject liquidity. Where that becomes problematic, again, it's not a bomb going off. This isn't instantaneous, but where it becomes problematic is the fact that it's going to cause have unintended consequences, or it's going to have there's going to be indirect things that stem from this. For example, let me back up and first say, think of reverse repos as the Fed trying to maintain an interest rate floor. They're trying to prevent interest rates from dropping too low. A repo is exactly the opposite. It's a ceiling on interest rates. So they're trying to prevent interest rates from going too high. Mm-hmm. And again, as we've now run out of excess liquidity, you're going to start to see liquidity fall below where the Fed wants it to be. And that's when you see repos have to kick in. We've seen a little bit of that, a few $1 billion here and there over the last few weeks. Again, it's not catastrophic. It's not a blow up like we had in September of 2019. But also, and this is why I say this is where the fun begins, the Fed is hell bent on preventing another blow up like we had in September 2019. And so you and I talked many, many times about how once we run out of reverse repos, the Fed is going to have to stop selling off the balance sheet. Well, sure enough, what did they just announce? December 1st, they're going to end QT. So they're going to stop selling off the balance sheet because, again, selling off the balance sheet is a way to permanently soak up liquidity, right? The Fed hands you a treasury bond and you hand the Fed cash. Yeah. Well, where does that cash go? It ceases to exist as soon as it goes back to the Fed. It's a permanent, again, reduction in liquidity. So they're going to stop that December 1, and shortly thereafter, they're going to have to restart QE, meaning they're going to have to restart purchasing net purchases of securities. That is going to be adding liquidity, but again, it's on a permanent basis. So between now and then, they're going to use the repo facility as a temporary way to inject liquidity, to keep the amount of reserves at the required level. But the market's just going to force their hand. And then we're going to be right back, unfortunately, we're going to be right back on the inflation roller coaster as they start printing more money.
So we go from quantitative tightening, reverse repos, to repos, quantitative easing. And it's easing because they're repossessing those treasuries, those assets, and they're injecting liquidity back out into the economy through the banks, through those that are selling them the asset, right? So we're going to shift now to quantitative easing. Quantitative easing is a way to try and keep rates down. So keep that ceiling on rates versus the floor on rates for quantitative tightening. One thing that we've seen is the banks are actually going out, and we have a graphic to show this, as the Fed is in repo mode or quantitative easing mode, the banks are actually going out and paying higher rates for money versus what they would get from the Fed at the repo facility. Why is that? Why are we seeing rates push higher even though there's a lower rate to be had through the repo facility with the Fed?
Well, in short, this is a sign of stress, and you can kind of think of this in the same way we see backwardation sometimes, and that's a signal. Hey, something's up with the market, right? Yeah. What we've noticed is the SOFR, secured overnight financing rate. You're talking about on the one hand, you have interest bearing loans. Or sorry, let me put it this way. On the one hand, you have secured loans, right? And on the other hand, you have unsecured loans. Well, which one should naturally have the higher interest rate? Well, the unsecured loans, right? Today, we're seeing exactly the opposite on many overnights, where you're actually seeing the secured loans, that interest rate spiking above the unsecured. So all of this points to stress within financial markets, and it points to a lack of liquidity. When you have not just ample but abundant reserves, as the Fed calls them, now you have essentially people constantly looking for places to park their money overnight. That's gone now. And we're kind of at a point where, if you want to think of it this way, supply and demand are perfectly imbalanced. So so you'll have one night where you see this, if you want to think of it as backwardation, and then it reverses the next night. So it's going back and forth. But the very quick and dirty answer here, Anthony, is the fact that it's a sign that you have sections of the market that are running out of liquidity. The plumbing is running dry, so to speak. And so other sections are having to make up for that. And you're seeing that cost borne out, that transfer of capital in the form of these higher interest rates.
Okay. All right. So so if that liquidity is drying up and that excess liquidity is not there, and we're seeing rates go higher, we're still at risk of inflationary pressures. We're bringing inflation down. So if we look at core CPI and PPI, we can see all of those numbers coming down. So we were, inflation up near 9% under Biden. We're back just below 3%, right, on an annualized basis in the CPI print. Is that right?
Right, exactly.
Okay. So, but we still have a liquidity issue here, and you can see it in the rates being paid. You could see it in the reverse repo facility functioning at the Fed. And you can see it in the fact that there's, as you said, there's backwardation. Where do we go from here? Like, how does this resolve itself? Does this need to blow up as far as a crisis?
Good
in order to
question.
get things to reset? And is the Fed even capable of letting that happen, or do we continue to blow hot air into the balloon and mask it and smoke screen it until it's an actual crisis?
Really, really good question, Anthony. I think unfortunately you're going to need somebody new to come in there to replace Powell in May and blow it up. And I don't mean blow it up in the sense of have a full blown financial crisis. I mean blow up the monetary framework. And I guess maybe this part of the answer kind of also answers your previous question to a certain extent, which is the Fed paying banks not to lend money
Yeah.
is a whole nother dynamic at play here that is preventing certain interest rates from behaving normally. Because think about it, if you're a bank, if you're a financial institution, you can park money at the Fed overnight. And I don't just mean in terms of reverse repos, which obviously are down to nothing. I'm just talking regular bank reserves. Before March of 2020, the Fed never paid interest on bank reserves. Yes, they paid interest on excess reserves after Bernanke, but your regular in order to meet your regular reserve requirement, you didn't get interest on that. You just had to keep the money parked in the Fed in reserve. That's gone now, and so that has, in its own way, imposed a new kind of floor on interest rates that is oftentimes preventing one bank from lending to another. Why am I going to lend money to somebody other than the Fed? When I loan it to the Fed, number one, it's a risk-free rate of return, right? The Fed can literally print its own money. It can't go bust.
Yep.
But number two, there's no term premium, right?
Yep.
I'm lending money to the Fed on an overnight basis and I get it back instantly the next day. So why on earth would I loan to anybody else, whether it's a fellow bank, whether it's the Treasury, whether it's the private market? I'm only going to loan if I get a higher interest rate,
Again,
right?
which is reducing liquidity in the system, which is part of
Exactly.
the strain. So are they doing what they've always done? I mean, I always felt like the Treasury and the Fed were working completely against each other, but not saying the quiet part out loud. The Fed seems to be internally working against each other. The QE/QT functionality at the repo reverse repo facility seems to be working against the fact that they're also paying banks to park liquidity, cash with them, and not provide that liquidity into the system. So the pipes are dry. They're trying on one hand to figure out how to get them to pump some liquidity, and on the other hand, they're taking liquidity out of the market. Like, am I? And then the rates are a whole nother question and a whole nother debacle. But do I
Yeah.
basically have this right? I mean, they're literally arm wrestling themselves.
100%. I'm going to steal that analogy if you don't mind. And Anthony, the result of all this, and here's where I'm going to, I did a lot of weave there, so I'm going to try to get back to answer your question. What's basically happening here at the Fed? You're absolutely right. They're arm wrestling themselves, and because they are working, at cross purposes with their own initiatives, they're just stuck. They've painted themselves into a corner and they can't get out. So the only way you do get out is you get somebody new in there to completely blow up the whole framework and say, look, what we've done again since the spring of 2020 hasn't worked. We're going back to the old way of doing things. We're going to reinstitute the reserve requirement. We're not doing this nonsensical paying interest to banks for not lending anymore.
Yeah.
We're going back to the way we did things for literally 100 years. Enough of this newfangled nonsense. It literally doesn't work. We've shot ourselves in the foot, and a big part of the discussion that people seem to be missing today, Anthony, when we talk about, oh, look at what's happening with inflation rates, with the unemployment rate. Isn't the Fed going to do X, or aren't they going to do Y? No, this is what people need to understand. They have their hands tied because of the monetary framework they have built around bank reserves. They're going to have to make decisions now. They already did. Again, look, they announced, as we said previously, they announced they're ending QT on December 1. There is no justification for doing that. The reason they have to is because they're trying to maintain this monetary framework that they have cobbled together. And the only way to do that is again, it's ending QT and it's going to be restarting QE. Their hands are tied. They've painted themselves into a corner.
So concerning on the market side, really quick. These are the type of things that become longer term stories. You hear about them, you get nervous, and then people start to get shorter, start to reposition, and then the market does completely what you don't think it's going to do. And this really is the value in having the model that we run here at Ascalon 6, where it's an objective model. It's showing what the market is doing, what the internals are suggesting will be the future move, and not paying we're paying attention to these data points. They're all anecdotal, but we want to know what the market is doing, not what the market should be doing. So the reaction to these things may or may not be what we expect in the short term and the intermediate term, but to be in position and watching these and paying attention to them is massively important. One thing that came up was the non-farm payrolls today. You had actually put a pretty good post out about this. So change in non-farm payrolls today. Survey was 53,000. It was actually 119,000. Prior was 22,000, and a very small revision, down 4,000 on the prior. So you were out kind of going at it a little bit. There's obviously been, it's not any secret that the BLS is not being run and has not been run true to form. There's been, mistakes there and just straight up incompetency there. Whether or not that was nefarious or whether or not that was by design, it really is irrelevant. The fact of the matter is it was way beyond, a low IQ, low functioning type of management there. I love the way you went at this. I do need you to kind of touch on this, because this is, you really are, first of all, your economic analysis, your policy analysis is always spot on, but you're always a gentleman. You're always like true to form. But I do like it when you get just a little hot under the collar. That makes me happy. I like that. I think of myself as a gentleman and a good person and a good heart. But it's always good to kind of see the steam a little bit and let people know that you have teeth. So you are at this just a little bit. I want you to explain, why is this such a kind of joke, the way this stuff gets framed?
Well, Anthony, this is the kind of garbage that was a big part of the reason why President Trump wanted to shake up the agency and had to fire the last commissioner. It was incompetence, absolutely. But then you see garbage like this, and again, you can't help but assume that there's got to be malice here, because this isn't just incompetence. This is pretty deliberate here. Since when do we talk about an increase of 119,000 jobs as just edging up? I mean, give me a break. They didn't say that, under Biden, when you had weaker than expected payrolls, and this was almost twice what economists were expecting. The whole narrative here is just absolute nonsense. And then we say, oh, and the employment level, or excuse me, not the employment level, the non-farm payroll level is little changed since April. Little changed. It's up almost 200,000. How is that a little change? Yeah. I mean, and again, why is it since April? Why not since January? Why not since June? Like, why'd you pick the month of April? Maybe it's because that's when Trump announced the tariffs, right? Which is kind of a hallmark of his economic policy. And I understand some people really love the tariffs. Some people hate them. I'm not trying to weigh in on that, but rather I'm pointing out the fact that the acting commissioner at BLS, who's in charge of writing this narrative, or at least proofreading it and signing off on it, you see something like this, it is so blatantly obvious that they are trying to say, look, since President Trump's signature economic move, guess what? The job growth has basically been non-existent. No, that's really not the case at all. Yeah. Again, it's amazing how we phrase these things. We're just edging up by 119,000 jobs, right? Oh, it's little changed. It's basically flat. It's 193,000 increase. Give me a break. Yeah. I mean, this is the kind of just blatant bias in you can call it the deep state, you can call it the establishment, whatever you want, but this is the kind of garbage that we're fighting against. And again, as I said in that post, it's amazing how they're not even trying to hide it anymore. The mask is off. They're just being totally above board, and just, again, it's blatant bias. There's no other word for it.
Yeah. I mean, this is honestly why you would have been perfect for that position, and the politics that got involved from the left and that kind of blocked that it's unfortunate for the country, to be really honest. And this is how I feel. We need more people like you who are data driven, objective, and in the seat, or taking the seat, to make things better and to help, and not to be political and not to be biased, and that's not what we need. but the system is a tilted, political biased system. So when somebody comes in that is data driven, that is objective, that is going to come in and fix what was wrong and take a look at, hey, why was this so wrong? All of
Mm-hmm.
a sudden, everybody's hair is on fire. I've never seen, I have to be honest with you, I've never seen so much attention paid to who was going to run the BLS as when you got nominated. And that to me should be a feather in your cap and a hat tip to you, because they got so nervous that you were going to actually be there and actually be capable, objective, data driven, step in and figure out what was going on, what needed to change, and how to make it right. To see them get that nervous about the BLS, I mean, it's like, no offense, but it's not the Department of War. It's not, right. It's not Secretary of State. It's the BLS. So people normally overlook it and aren't even paying attention to it, even though it is very important. But the fact that they got so excited about you stepping in shows me that there was a real hot button there, and shows me that they know exactly what you're about, which is exactly what we need. Unfortunately, the swamp won on that one, and that was a loss for everyone. But I give you a lot of credit for how you handled it. Again, you handled it like a gentleman. You went through the process, and you got caught up in a lot of politics. You kept your way about you. You kept your chin up, your chest out, and you moved on. And you're still the same man. So that's to your credit. And I appreciate that. I wish that you were in that seat, to be honest with you. The only advantage for me is that you're in that seat because you're not in the other seat. So that works out to some degree.
That's very kind of you, Anthony. Very
I mean
kind.
it, man. I mean it. It's unfortunate. I have some really close investors and friends out in Utah, and it's the same type of thing right now. They have a judge there who waits till last minute, decides she's going to make a call on the redistricting map, which is completely illegal. It's against the state constitution. That is a decision for the legislature, not for the judiciary. And
Mm-hmm.
now they have to fight to get the law to be adhered to by a judge. It's insane. It is absolutely insane, but it's the same concept, right? It's all being done out loud. It's all being done right in front of you. And until we decide to step up and have the laws of the land adhered to and enforced, we're going to continue to have things happen, and we're going to continue to spiral into risk as a nation across
Yeah.
the board. Social risk, economic risk, geopolitical risk, it's all risk. And there is a ton of it out there. Anyway, as we move forward, I thought this was pretty interesting. We're talking about the Fed rates, monetary policy, quantitative easing, quantitative tightening, and then we went into obviously talking about jobs and the economy. One thing I don't think people really understand the magnitude of what the type of economy we have that we've shifted to over the course of the last century, and the magnitude of that shift. So I pulled up three quick tables on how the U.S. functions and how we kick in. So we are not a production-based economy anymore. We are an asset-based economy, meaning the assets that we hold, financial, real estate, investments, those assets actually run the economy. They're the core at what we do now, not production.
Mm-hmm.
77 to 87% of GDP, according to my run, is based on those assets or servicing those assets. So think about that. You're talking about 3/4 of the GDP production in the country no longer making stuff, no longer building cars and machinery and
Mm-hmm.
making things that, if you drop them on your foot, they hurt. We are based on assets, and we're based on servicing those assets. Manufacturing is around 10%, construction 4%, ag and mining 1 to 2%. Let that one sink in. Agriculture and mining 1 to 2% of our GDP.
Mm-hmm.
That is a serious issue. That's a serious issue. So when you look at it that way, and you start to think about the Herculean task that President Trump is taking on, right, to actually shift from public investment and a publicly smoke-screened, government smoke-screened economy, he's trying to pull back and shift a century of movement away from manufacturing and production in 4 years, or at least get that really going in 4 years. And how has he done that? Well, part of how he's done it is he's started to eliminate the government waste and the government jobs, and taking that focus and then taking some of the tariff conversations and the trade deficit conversations and pulling in foreign investments to build factories, to build manufacturing, to onshore that work and make manufacturing, production, construction more an onshore U.S. GDP input versus an imported trade deficit input, right? So that's the first thing. But the understanding that we are an asset-based services of those assets-based economy is really important. I don't think that people understand the magnitude. The
Mm-hmm.
second chart that I ran talks about the contribution of assets and how wealth is created. So if you look at wealth creation, a lot of times as we have these conversations about equity and equality and the economy and all, let's have the conversation. I'm all for it. But the bottom line is, why is wealth creation focused on assets and those that hold assets and hold stocks and hold bonds and hold real estate? Well, 60% of the financial assets and 60% of that wealth creation in the country is tied directly to financial assets and real estate.
Mm-hmm.
25% is tied directly to equities, right? So if we're an asset-based economy and you don't own assets, and the economy's growing, well, the economy's growing because the assets are growing and expanding. The value of those are growing and expanding. By the way, that is a constant need for inflation if you haven't caught on yet. Assets
Yeah.
need to be priced higher so that the economy can grow and GDP can grow. But as assets are priced higher, more and more dollars need to buy them. We are driven by inflation. That's why the Fed has a 2% target per year, which again is insane. Why do we
Bingo.
want our dollars to depreciate every year? Why is that our target? Anyway, 60% of wealth creation in this country, financial assets, real estate, 25% equities, 30%, another 30% well, 30% of that in real estate. Only 5 to 7% of the wealth creation in the country is based on production, business equipment, machinery. So the real things, the productions, the manufacturing of things. The
Mm-hmm.
point to all of this is everyone needs to understand we live in an asset-based economy and an asset-based country. So those assets are going to have to continue to increase in price so that the economy continues to function. If we can bring back, all right, we can bring back some manufacturing, production, and create GDP growth, real dollar growth through making things, through guys putting on their hard hats, taking those old metal lunch boxes, that picture of the Western European immigrants sitting on the high risers, building the Empire State Building. Like that's America. That's Americana. That's how we can get back to spreading wealth in the country, right? Because now you can go to work and make stuff and be a part of the economy, right? And your dollars will be worth more because the dollars you're taking home in value and real value will start to increase. So I think everyone needs to understand the task at hand for President Trump and the new economic agenda.
Mm-hmm.
Everyone needs to understand where wealth creation and where the economic growth really is in the country, and understand that the moves here are truly setting the runway for economic growth through production, through manufacturing, through agriculture. Make stuff that we need, consume stuff that we need, be our own economy, be a real functioning economy with stuff, not just with services and assets and make believe. I'm managing Ascalon 6 every day. And I kid around and say some days it's like you're literally playing Atari. Everything's real, but it's kind of not. Like I am managing assets, and it's a real thing, and it's extremely difficult. But at the end of the day, I'm not brick and mortar. I'm not building stuff. I'm not packaging stuff up. I don't have a finished product running off of the assembly line.
Mm-hmm.
That's where we need to get back to. It's a hard, heavy lift, but I think if we can do that, we put ourselves in a better position for true economic growth and long-term security and growth. So that's kind of my spiel today on the economy and how we're kind of what are the attribution points of the economy.
Yeah, I think that's great. Great analysis, Anthony. And look, it's the Treasury Secretary who talks about how the economy is out of balance. Right, we have too much over reliance on certain sectors, and we don't utilize others enough. We've kind of just let them atrophy, like what you're talking about with manufacturing and construction and all those hard assets. And that you can think of it, I guess, in a certain way as a kind of leverage, and leverage is risk, right? So by doing that rebalancing, as it were, we're reducing that risk so that when you do have a downturn, whether it's the .com bubble or whether it's the housing bubble, when you do have those downturns, you're not going to have one sector that has dominated the economy that can take everything else down, I guess.
Absolutely. I mean, honestly, along those lines, it's obvious the market. I would definitely like to hit on this for a second. You talk about one dominating force. I mean, we've watched seven names, the Mag Seven, control the S&P 500 now for years,
Yeah.
and it's getting kind of tiresome. The market's been pretty volatile heading into the Nvidia report last night. Um, Nvidia pops on the report. Guys were kind of selling. We've been down peak to trough over the past few weeks, about 5%.
Mm-hmm.
My note and my view has been my model signal has been negative, and that's been a productive signal. And I kind of lined off 6730 for reasons of consolidation within the pattern. So I have 6730 as my dividing line between a short bias or a long bias. And then I would
Mm-hmm.
need here confirmation from my model to be long or short, right? So I'm not just putting the trades on. I need that confirmation from the rule set. But in addition, 6730 has been my kind of there is gray matter between my ears. So, below that line, I'm not looking to be long, and above that line, I'm not looking to be short. There's been a lot of volatility here. Nvidia, just to think about how volatile this stuff is, Nvidia had this massive pop, heading into the report, and then sold down. Actually, had massive pop prior to the report, sold down 16% to about 180. Opens today at 195, trading 184. Like, it's all over the place. And the
Yeah.
futures, I mean, the futures peaked up at 6,800 on the front month S&P. And just because Nvidia took the hit, they sold down to 6,600. 200 handle move on the futures. That's the S&P futures. Almost 3% peak to trough today.
Mm-hmm.
Based on NVIDIA, the report, and the AI conversation. So are we concentrated? Yes. Is concentration risk? Yes. You need to be aware of exactly where the risk is, where the concentration is. The VIX, just as a quick one, we're actually heading into backwardation now in the VIX term structure. The VIX today is up 40%, which I love because the front month VIX is part of our strategy. And I refer to it as the Tasmanian devil of the portfolio, and it is, and we manage it well, and we're friends. But I understand that if I leave my hand in the cage too long, I'm going to get bit. I'm well aware of that, and I've been managing VIX futures for 15 years now, so we're in a good place. But there's a lot of concentration and a lot of risk. The last thing I'll say is I do have a negative signal on the S&P here on the trade. I do see weakness looking out intermediate and longer term, very similar to what I saw. And I don't want to do that again. I feel like I'm Hakeem Jeffries. I'm putting my hands down. Very similar to what we saw back in December, January, February, as far as the intermediate and longer term signals shifting down to neutrals to negatives as the trade signal saw some volatility, even with some positive signals. What I would say is I would be trade signals negative. We're below 6730. The bias here is short. It looks more like a short bias and a high vol bias. I won't say short regime, high vol regime, because that starts to take us out into intermediate term, longer term. But we have a bias here of short and high vol.
Mm-hmm.
I would expect, and front month futures right now are at 6638. We held 6600. The 100 days 6606. We're slicing through the lower Bollinger Band. All these things are looking like there could potentially be, short of 6600 breaking, we could potentially see a hold here and a rally into the end of the year. And I think the Nvidia kind of spike, washout, anticipation, spike, washout, reset is kind of what we're seeing here. So I am biased short here in the portfolio based on my signal, based on being below 6730. If we were to break 6600, I have 6540 as my next level, my next downside target. If that breaks, we're starting to pin our ears back and really, really buckle up. I don't expect that to happen. My expectation would be if I could look out of the windshield and not the rearview mirror, as I like to say, my expectation would be a hold here. maybe a little bit of consolidation, and then a pretty hefty spike back through 6730. And I think we could potentially see a run towards 7,000 by the end of the year. I say again, signal right now is negative. Below 6730, either be short or be flat is my approach here. But I could easily see this as a hold, a washout, and then a kind of rally into the end of the year. And will that be right? Will that be the right trade? Depends on your timeline. It might be the right trade through the end of the year. Q1 might not be the right trade. Overall, I do see some weakness developing, but that could be 1, 2, 3 quarters out. We'll see. But for now, stay cautious below 6730. I can see us shifting back to positive, getting through 6730 to the upside, and taking a run back up to 7,000. So that is that's on the deck. That's a consideration. That's what I have for the market today, sir.
Love it. Absolutely love it, Anthony. See, this is why I trust you, because you have that kind of in-depth empirical analysis, right? It's rules-based. It's not, well, I got a feeling we're going up or down. I mean, can you imagine like that? Because that's how most day traders operate, right? Yeah. Most of these novices, the people who just get crushed all the time. I mean, they are just they're taking a toweling, to put it politely, the last couple of days on NVIDIA. Can you imagine people who flooded into NVIDIA after the big earnings beat, and then today they just got, they took it on the chin, to say the least. So
that's right. Now those guys that have their, the fundamental analysis and the growth story, the AI story, it could become the right trade. Again, depends on your timeline, but NVIDIA could hit 300. I honestly, if we were going to talk fundamentals and what's logical, we're beyond that. We're always beyond that. We've lived beyond that since 1987. So I don't know. You have to look at what it is and what it could be. I think people get hurt pretty quickly, and those that are day trading and trying to kind of play it, for every 1,000 that do that, one will be successful. It's a painful game,
and it's because they got lucky.
It's painful, and I've seen a lot of guys fail at it, and that's where the model comes into play 100%. Thank you, everyone, for joining again this episode of Policy and Profits. I'm Anthony Esposito at Ascalon 6 Capital. You can check me out at CMT_Anthony on X. You can also check out the website for more information, daily reports, and some media hits at www.ascalon6capital.com. Really appreciate all the feedback. We are out on YouTube, so come take a look, check us out. Happy to field any questions that you may have. You can also hit me on email at anthony.esposito@ascalon6capital.com. EJ, you are clearly out on X and still posting, and I'm glad you are. Well, the one reason I'm glad you're not at the BLS is that you are posting. Your handle at Real EJ Antoni on X. Definitely, I know, looking to get some feedback there as well. EJ?
You got it, Anthony. And please, everybody, feel free to leave comments. Subscribe to the podcast. Like Anthony was saying, you can find it on YouTube. We'll both post episodes on those X feeds as well. So leave us comments, let us know your thoughts, and give us your questions. If there's stuff you want us to talk about, let us know so we can address it.
See you next time. Thank you.